guys. This is part one of a deep dive of a two-part episode. We're breaking down where the smart money is flowing across Southeast Asia, starting with a sharp look at the funding trends, the barbell economy, and why early stage founders are struggling to raise. Now let's get into it. So, you might be wondering, where's the smart money flowing in Southeast Asia? And today we're here to answer that. We're tracking the real moves from infrastructure bets to policy plays, reshaping the region's tech future. Welcome to the Sea of Startups. I'm Kim.
And I'm Kevin. This is now episode 4, and we're talking about where's the money actually moving, from infrastructure bets to policy nudges in Southeast Asia's next tech phase. We've got a number of things on the docket today. We're talking about the funding snapshot that came out of the first half of 2025. We've got AI data centers coming up in Jakarta. There's some trends across the region as well. And then, of course, we're going to wrap it up with some of the recent policies and efforts coming out of my home base, not home country, but home base, which is Malaysia. So we've got some exciting stuff to talk about.
Well, let's dive in. First up, let's look at the funding snapshot. So, Kevin, I hear Southeast Asia's venture scene in the first half pulled in about $2 billion, but it's not exactly a Trumpian headline, right? I mean, what's going on, really?
Yeah, so there's a bit to unpack out of this 2 billion figure. So, first half of 2025, Southeast Asia tech startups. This information came from Traction. So just to put the reference out there, what it showed was a basically double digit drop, 24% drop from the second half of last year. So half on half, 24% decrease. But comparing it to the first half of last year, it's actually a slight uptick, but it's not all rosy news. It's actually quite the barbell scenario, to where on the extreme of the late stage funding, we've seen an increase. But the worrying part of it is that early stage has really collapsed.
Oh, wow. I mean, a barbell, huh? Like, so beefy in the ends and then skinny in the middle. Like, how does that look? How does that work?
Yeah, so basically, you've got the early stage startups is just much less funding is going into it. And you see not only less funding, but lower deal count as well. And so you're really starting to see a huge retreat across this. And, it might be a signal that investors are slamming on the brakes. They're not so into the new and risky bets. You may end up seeing that maybe it's just a lack of new startups coming out. You could put your explanations. But the big thing in my mind is, if you don't have new startups, where are tomorrow's late stage companies going to come from?
Yeah. And meanwhile, what's the other end of the barbell then?
Yeah, on the other side of it, you actually did see late stage pick up.
Yeah.
So you saw an overall increase happening in the late stage. Although funny enough, it was fewer actual deals that
Mhm.
happened. They were just larger in size. To put some numbers on this, there was 1.4 billion in deals at the late stage across 10 deals. That's about 140 million average per deal. You had some sizable ones that were in there, like Superbase, a couple other numbers. But if you compare that to the last two halves, so like second half of 2024, it was just over half a billion. And it was roughly similar in the first half of last year as well. But on larger deal counts, it was 15 and 14 respectively, which signals that it was a much smaller average deal size for those two ones. And so this could be just the quality rising to the top. There's still a lot of cash out there looking for a place to go. They are great companies. Like I said, you had Supabase end up getting funding, Air Wallet. You've got some of these guys that are raising big names, big rounds.
Yeah, and it seems like pretty much like what we said before. The funding cycles has been pretty much retracting a lot. Like, not in terms of the activity, it's not as active as it used to be in 2021, and it's looking at big qualities, like you said, investors are in a flight to quality mode and only backing safer later stage bets. I mean, didn't we see something similar like in the States as well recently?
Yeah, so I mean, the U.S. has gone through like boom bust cycles few different times. It is actually a natural cycle to be going through. So it's not that we should start sounding the alarm and saying that venture is dead or anything like that. It's healthy cycles, because in all fairness, I do believe that we had quite a bubble in Southeast Asia. When we're looking at the aggregate, not every country actually inflated a bubble, but across the region, there was just too much capital chasing too few deals. And what ended up happening is that we had this explosion of deals that probably shouldn't have gotten funded, getting funded. We saw valuations increasing above where they probably should have been in the first place. And now a lot of that is coming through in this correction. And because the market's nascent, we could probably draw the equivocation to like the dot-com bubble. Obviously, the technology is different, but in regards of like early growing pains of the ecosystem, it's definitely one of the early boom bust. But we'll come back, I believe, because the enabling characteristics of the region are still there.
And when you say we come back, so it's like what, the seven, you think it's similar to the typical equity cycle whereby it's a 7 year thing, you have this up and down, and it happens every 7 years, or it's very much dependent, it's still very random, there's no cycle, it's not as systematic compared to the typical equity cycle? Do you think that that's going to go in that direction, or it has its own rhythm, is what I'm saying?
I think it has its own rhythm. I think a lot of it ends up being globally connected, to be honest with you, but with a little bit of a lag to the West, for example. But a slightly longer time to recover. So it takes a while for it to hit us, and it takes us a little bit longer in order to recover. That cycle will probably change as the maturity of the ecosystem develops. That's happened in other ecosystems. You can see it in India, in Europe, in some other ecosystems that have kind of where the correlation effect has become a little bit more independent. But I do think that the other factor of like, as the technology cycles themselves are speeding up, it's still to be determined how this will impact the boom bust cycles. It would be hard for me to say that there's not a little bit of a bubble forming in the AI. There's a lot of capital flooding into it. We talked about AI in the last episode. There's definitely something there. Not that the long-term trend of AI is not going to end up being positive, but you have this natural excessive exuberance that comes in when something's new. Southeast Asia was new for a lot of folks when a lot of money started flooding into it. And now it's having to go through those growing pains. We'll have to kind of reset, redefine, and it'll start coming back again.
So then my next question would be, do you think this rhythmic cycles, we need to still find a rhythm? It rides on the tech as well, right? Like AI. Now it's like so much of money coming to AI.
Yeah, I mean, the cycles impacting the boom bust cycles of VC are going to be linked to the new technologies. It's going to be linked to a few other global factors, but without a doubt, like we can think back to the mobile first bubble, the blockchain bubble, different instances where something new came out, and all of a sudden everyone was like, "This is the future. Let's flood everything into it." And, when everybody's chasing the same direction, inevitably you're going to end up having not the most sanest of decisions making their way 100% of the time. Not to take away from some of the companies that come out during that time period, because like, let's be honest with it, like Amazon came out during the dot-com bubble, and, now they're one of the largest companies.
Yeah, and which brings me to the little guys, right? Like early stage startups that are left scrambling. And that has implications. And fewer seed investments now mean a thinner pipeline of Series A and Series B in the coming years. Could this be setting us up for a longer term innovation gap in C?
Yeah, this is honestly, from my standpoint, a worrying sign when you see just significantly smaller numbers of early stage deals. So I'll jump back into some of the numbers that came out of this report because it showed some of the progression over time. If you looked at the first half
Mhm.
of 2024, it was
Mhm.
basically about 200 seed stage deals. First half of
Okay.
25, 56.
Wow, that's a big drop.
That's a massive drop.
Yeah.
You know, if you
Yeah.
go back to the second half of 22, which is kind of bubblish time period, 245. So we're
Wow.
down 80% in number
Yeah.
of deal count.
Yeah.
Not necessarily in the dollar flow, but we're talking about deal count, the number of startups that were getting funded.
Right.
And
Right.
so that's a worrying number. Whether we're looking at from the 245 or from the 200 last year, we basically wiped out three-quarters of the amount of deals. So don't have the company-wise numbers in this report at my fingertips, but it does pose the question of: are we just seeing less quality startups,
Mm.
which is an indicator of why so few deals? Is it the factor of the VCs just aren't investing? Or third possibility, because of the new tools that we have to become more cash efficient, are less startups looking for funding? So there's three scenarios. I think we're a factor of all three of those that are going on
Mhm.
and why this number is so low.
Mhm.
But the implication is, think of it like a sales funnel. The
Yeah.
top of funnel narrows as it comes down to a final close. Same sort of funnel visualization when we're talking about the different stages of funding, which, wide funnel at the seed stage, a little bit more narrow at series B, a little bit more
Yeah.
narrow at series B, and so on until it's acquisition or IPO. Or so if we don't have enough at that top of funnel, what's the middle of the funnel going to look like in a year's time? Because this is generally a leading indicator of who's going to be fundraising later.
Yeah.
And if we don't have the numbers now, are we going to have the numbers later?
And fewer new companies being nurtured means fewer future unicorns or regional champions.
Mm.
That is kind of worrying. Like you said, massive drop, and I can't get over that big drop. Everything seems to be moving, and then on the flip side of it, VC seems to be stalled. So do you think perhaps I'm just throwing in at the fourth reason, like C could be facing a kind of a generation gap in startups if early stage funding remains in a slump? And speaking of unicorns, how many did C mint in the first half? Like globally, it was what 35 new unicorns in that time.
Yeah, that same report said that there were 35 new unicorns during that time period, and Southeast Asia minted one of those. No, I'm quite adamant that the terminology unicorn shouldn't be the definition of success, but as an
Yeah,
indicator of, are we building sizable companies? Because every report always wants to use that terminology. We only got one.
percent of the
Mm, mm,
that's
yeah,
crazy.
it's a relatively low percent. It's better than zero.
Yeah,
But certainly, the lion's share of that is coming out of developed markets. I can't remember the number offhand, but I think the dominant portion of that actually came out of the US, which was
yeah.
probably all these vibe coding AI startups that all of a sudden became uh, hugely massive within 5 days of being started.
And that one and only that sole unicorn happens to be no surprise, Signum Bank, a digital assets tech firm based out of Singapore, and it seems to be hogging the funding pie. Really, I mean, oops, but yeah, seems like
Yeah.
it.
Yeah, so the other thing they made note of was that 92% of all VC funding in Southeast Asia during the first half of 2025 was in Singapore. Now, this may sound extreme, but I question the validity or the true indication of the data. And I say that solely because most times, and I didn't see the footnotes in this report, so but I'm going to make an assumption here that this is the case. Almost all the companies in Southeast Asia, as you start raising more meaningful amounts of money, you get a holding company in Singapore and you raise via that holding company in Singapore. You may still have your operations sitting in Jakarta or Manila or Kuala Lumpur or Bangkok or Ho Chi Minh or wherever the case may end up being. But you put that Singapore holding company so that you can raise more regional capital. So when I see that 92%, I'm like, well, why is it not 100?
Yeah. It's kind of misleading. It's just so lopsided. And essentially, almost all the money went to Singapore based companies or deals. And that leaves about 8% for the rest of the regions. Peanuts when spread across Indonesia, Vietnam, and
Yeah.
etc. And
Yeah, I would take this in a slightly different way personally. Is
yeah,
I wouldn't necessarily say this is a true indication of the startup ecosystems around the region.
okay.
Because again, there's a very good chance that many of that 92% number are actually living, operating, and building out of some other country besides Singapore. What
Yeah.
I would take this as it's a demonstration of the investor sentiment of the trust factor of Singapore. That many of the countries around the region still have a long way to go to build that global credibility, regulatory policy consistency, because many of the countries have started to try and put out new policies. But Singapore has had multiple decades of quality, consistency, predictability, and it's a very black and white. Everything fits in the box. There's very little gray area. It's predictable that way. So there's a high trust factor in regards to what's going to happen with my money, the tax, regulatory, etc. And it's not a snap of the fingers thing that any of the other countries in the region can do. But I take that 92% as more of an indication of the disparity between that perception and why all these companies need to have holding companies in Singapore if they're going to truly raise, instead of a quality of the startup ecosystems themselves. I take it from a slightly different lens, but it is an important factor to think about.
Yeah, it is. I mean, I can't agree more. Like 92% is wow. If you flip on the other side of it, it's like Southeast Asia's venture scene is pretty much in Singapore. But to your point, to credit the Singaporean government as well, they've done a great job in terms of setting the scene right, and it's actually worked to their advantage. I mean, if you put VC aside and you look at it from a pop culture point of view, it's slight tangent here, but I have to say this. For example, like Taylor Swift, they had a contract with Taylor Swift. None of the Southeast Asia countries that Taylor Swift could perform in. That's massive. They literally wiped up everything from the region's tourism inflow to Singapore. And
Mhm.
same goes to Lady Gaga. It's a very calculated, very smart move from the government, and it translates into the VC scene as well. And
Yeah,
I'm not surprised, that they are doing a good job. I mean, coming from Malaysia, I'm just gonna give Singapore its credits due. I think, yeah, yeah,
yeah. Do credit
um,
deserved. I mean,
yeah,
it's
due,
it's it's
exactly,
it's it's not unintentional.
yeah,
I don't think
yeah,
they're out front in saying this is our
yeah,
intended strategy, but they do try and lure companies into Singapore, whether it's the full operations as they've done. Coming from Malaysia, the Grab story of like, you want our money, you should come here. There's a number of other stories of many, many, many other startups that they've done the similar sort of thing with. They're investors in some of the corporate secretary entities that digitalize it and make it easier to put the holding company in Singapore. It's well established. It's understood. And I don't see that wall tearing down anytime soon. A lot of the startups that we invest in ourselves, they have Singapore registered entities. And we tell every company that doesn't have one that if you want to raise increasingly larger amounts of money, you do need to set up a Singapore holding company. It's the fact of the matter. It's just the way things are. And it takes a long time for any other country to consistently implement and remove those barriers. It's not something that you can put in all of a sudden and change. Uh,
yeah.
But anyway, so there's a number of other factors in the report that were pretty interesting as well.
Yeah, and I guess it's also a resilience issue as well. An ecosystem heavily relying on one hub. But what about other sectors? Are there any insights into where the money went? It seems like the sector breakdown is pretty interesting. Um, you know,
Yeah, yeah. So this fits quite well for us because
yeah,
we're a solely B2B tech investor, and I've long talked about the thesis in regards to Southeast Asia. But what's proven out is that there's a natural evolution where the majority of the startup ecosystem will start as consumer, but as it matures, it'll start flipping to where the dominant market value is being created on the enterprise or the B2B
mhm,
side of it. And what
mhm,
this actually shows is that the majority of the investments were going into those types of sectors. A lot of it is dominated by some of these mega deals that ended
yeah,
up happening, and as we
Supabase.
referenced before, yeah. So like enterprise infrastructure, Supabase ended up getting a massive deal. Fintech, we already talked about how Signum Bank ended up getting a massive investment. But you also have like enterprise software and applications. So there's this switch more towards B2B and fintech. A lot of the thesis around consumer hasn't played out the
Yeah,
same way that people have anticipated. And also, you're starting to see a rise of a new crop of B2B companies. So I
yeah.
think it's painting an interesting picture of what's going on in the ecosystem right now in regards to the maturation.
And it's also quite conservative. Like, investors are doubling down on what's working, fintech, B2B. I just have to throw this in. Like, the conversation with Chris last week also kind of add some volume as to how agentic AI and how B2B is going to take flight from there, and shelving the moonshot ideas for now. And the vibe in the first half of 2025 is like, show me something proven with revenue and I'll write a big check. Again, I'm trying to tie in parallels to seed strapping.
Mhm.
So um if you're early stage or unproven on, they're pretty much not interested. It's a cautious and almost survivalist mode for VCs right now, and they're conserving funds and follow-ons for their winners rather than betting on newcomers. And the cycle as well is pretty much riding on that too. Investments are more contracted.
Yeah, without a doubt, it's an extremely tough fundraising environment. It's a wake up call for early stage founders, the policymakers, and the other ecosystem builders that are trying to encourage the ecosystem to try something different. In my mind, the strategy that was put in place didn't play out the way that they thought it was going to play out. So the results didn't come in. So a lot of this conservatism from the funder side is also a reversion back away from strategies that didn't work for them in the past. Most B2B is operating off of subscriptions or transaction fees. They're based it off of usage. There's these aspects that have a little bit more predictability. A lot of the big companies are now getting these larger size tickets. They've worked their way into being more of the entrenched operating layers, whether they're true infrastructure or system mission critical. When you stumble upon these opportunities where you can build a startup in that space, you have something that becomes very, very viable, and it's less prone to the fickle nature of the consumer because enterprises can't just rip and replace so easily. Now, maybe in the era of agentic AI, which is still coming down the road, we'll see what the impact of that is. But for the time being, there is kind of a reshaping of the understanding and the perception of viability and taste, because in a lot of investor circles you talk about investor taste, and those taste buds seem to be changing a little bit more towards B2B tech, at least from some of this data.
Time will tell. It's a tale of two extremes. And speaking of extreme, let's transition into a second story, which involves an extremely large investment, but a different kind. And this one's big, literally. But we're gonna have to leave you hanging for now. So we've got a barbell structure, drying early stage capital, and Singapore is still eating most of the pie. And that's a wrap on part one. In part two, we'll unpack one of Southeast Asia's biggest investment plays, Jakarta's 2.3 billion AI data center, and Malaysia's bold startup policy reboot. Trust me, you really want to get first tips on this one. I'll catch you in the next episode, and if something here made you think a bit further or resonated with you, share it with a founder, friend, investor, operator, anyone who you may think may benefit or learn from this conversation. And just a heads up, everything we talk about here is based on personal perspectives. It's not financial advice, and we're not speaking on behalf of any organization or institution for that matter. Hit follow so you don't miss out on part 2. See you on the next one. Peace out.